Oh, wait.
Hi. Yep, we're all set. You all set?
Yep,
Okay,
good.
great. Hi, Paul.
Good morning, Olga. How are
Good
you?
morning. I'm doing great. I wanted to thank you so much for jumping in and having this conversation with me. I just wanted, I have a bunch of questions, and in the beginning, I just would like for you to introduce yourself a little bit to everybody who is going to be watching, and just tell us a little about yourself and how long you've been in the business.
Sounds great. Paul Clough. My company is Fresnel Partners. I have a partner in this business, and we've been working together for 10 years. And I'm a CPA, and we try and help people, our clients, minimize their tax liability and really help them with planning for that. And it's not always clear to people what they should be doing. And so I thought, when you mentioned this, I thought it'd be great to help provide people with some guidance.
That's great. How long have you been an accountant?
So I've been an accountant since I got out of college. And as you can tell, that's a while ago. I've been focused on doing individual and company taxes really for the last 10 or 11 years.
Got it. Okay, perfect. Well, the goal for today is we combined and compiled a list of questions that I have been getting from my clients and friends and family members that has to do with some of the general questions that I'm sure you get as well on, what to know and how to know. And also, more importantly, because of an interesting year that we had last year, there were some changes, there were some stimulus payments that were made. So we have a couple of questions. And what I also want to make a point is that I have no problem. And this is what I love about being able to partner with you, is that I can call you pretty much anytime and ask you questions, and you're always there to answer. And I think what I want people to understand is that you can have a great relationship with your accountant. It's not someone scary who's sitting in the castle somewhere, but I think it's even better to be proactive and actually ask these questions, so that way people can make plans, like you said, and understand, what is taxes and how to be prepared, so that way you're not scrambling at the end of the year and, when it's time to file. So,
In fact, before you get going,
yeah.
we wish our clients came to us before they make decisions and they do things, because sometimes people come to us after they've done something. They've bought a property, sold a property, taken money out of an IRA, and then they're surprised that they can't do anything about it. Whereas if they'd asked the question and they did things just a little bit differently, it could make a big difference for them. So we really encourage people to ask questions up front.
Perfect. That's a very good point. So what I wanted to start out with is, what do we need to know in terms of tax law changes, and because of the stimulus bill that was passed at the end of December? So what can you share?
So there's this was a stimulus bill, but it was also a tax bill, and it was also an appropriations bill. So there was a lot that Congress crammed into it. And by the way, one of the things people often ask me is, why does it work this way? And the simple answer is, it works this way because that's what Congress negotiated. And so the collection of things doesn't always make sense, what they put into it. But a couple of the key provisions. First of all, they for business owners, they extended and reinvigorated some of the programs to provide business with support during the pandemic, including the payroll protection program, the employee retention credit. For individuals, they passed another round of direct payments of stimulus money. The first round was back in April, and people should have received, under a certain income level, people should have received checks of $1,200 per taxpayer and $600 per qualifying child, which means under 17. This round is $600 per taxpayer. So if you're married, you would get $1,200, and if you had a qualifying child, another $600 for each of those qualifying children. And that's probably the biggest direct thing that people will feel right away.
Okay.
And those new payments, here we are in mid-January, those new payments, they directed the IRS to pay immediately. And so I am aware of some people that have received them, but I also know clients that haven't received them yet. But
And
they should be getting them soon.
and the second round that was passed in December, is that based on certain income level, or is everybody going to get that?
Yeah, both rounds were based on income levels. And because of the timing of the first one, the IRS was directed to kind of use the latest and greatest information they had. So if people hadn't filed a 2019 return, they were able to go back and use 2018 results. And sort of just as a rule of thumb, your income had to be under 75,000 per taxpayer. So if you were single, it had to be under $75,000. If you're married, it had to be under $150,000. So if you're below those levels, you should have gotten all the payment. If you're above those levels, it would have phased out. Same thing is true this go round, only they base it on 2019 tax returns. So if you haven't gotten either of those, but you are entitled to based on your income in 2020, you can claim that credit on your 2020 tax return. And so you'll need to know whether you got that money, both the round in the spring and then the round now, when you prepare your taxes this year.
What if a person does qualify based on the income that you specified, but they haven't received either of the stimulus payments? Do they need to contact IRS? Like, how is that going to reflect on their 2020 taxes filing?
So the IRS has created a way to incorporate that into your 2020 tax filing. So for example, if perhaps you made a lot of money in 2019, but not so much in 2020, and we know there's a lot of people that are in that situation, and you're entitled to it for 2020, you'll fill out some schedules on your 2020 tax return, and that credit will either reduce your taxes or increase your refund from your 2020 taxes. So you'd be able to, quote unquote, claim that rebate at that time.
Okay, so if the person did not get it, one of my clients was asking that question, they're going to be able to answer that on that form that you mentioned, correct?
And you might want to file early, just to make sure that you get it promptly when you need it most. I'd recommend that.
And in general, are we still on April 15th timeframe for filing deadline this year? Nothing changed like last year?
We are as of now. And there's been discussion about extending it. And I was in a continuing education class a week or so ago, and evidently the federal government is sort of in favor of it. However, the states are lobbying against it. And I think the reason is the states, the federal government can print more money. And they're doing so with these stimulus programs. The states don't have that option, and they need to get their tax revenue. So we know the new president is talking about additional stimulus money. Right. We don't know what, again, Congress will negotiate, but it's possible that a delay on the filing deadline could happen again, but it's just too early to know. Nothing yet.
Gotcha. Okay. And you also told me that the mortgage insurance premiums, and that's part of the mortgage payments, are treated as the interest for another year. So that's tax deductible, correct?
Correct. And that's an interesting one, because going back several years, Congress allowed that to be treated as interest for 1 year, and then it expired, and then they extended it, and then they passed another law to extend it, but they keep doing it 1 year at a time. And so they keep extending that 1 year at a time. And so I don't know how long it will continue to be, whether they'll ever make that permanent, but they keep extending it. And the December bill made it deductible as interest for 2020.
Got it. Okay. Let's talk a little bit about unemployment that people received during the pandemic. Is that income generally taxable?
It's taxable at the federal level,
okay,
but not at the state level.
Got it. So, and that applies to all states?
Yes. We're in Pennsylvania, and we have clients in New Jersey. And I also understand that there's a state component to that. And then people got an additional $600 per week that was a federal benefit. So Pennsylvania is actually going to issue two separate forms to people who had received it. One for the federal component and one for the state to tell you how much you got so you can include it in your taxes. New Jersey, interestingly, is doing it a different way. They're putting it all on one form. And so you'll get that. But just the way you get a 1099 form, if you get interest from your bank, you'll get a 1099 form for the unemployment and have to include that in your tax return.
Got it. Okay. I had this question not too long ago from a client of mine, and what she wanted to know is if you're doing major renovation to your house, right? Let's say it's, you're remodeling your kitchen and you had to put new siding and roof. You're talking about, $40, $50, $60,000. Is there any way to deduct that cost on taxes to get some kind of a tax break?
The short answer is at the time you do it, no. And what happens is if you bought a house for, say, $200,000 and you put $40,000 into it, when you sell it, now you're what the IRS calls cost basis is now $240,000. And so you calculate any gain on the sale based on that higher amount of money. The reality is these days with the law the way it is, as long as you've lived in a house for 2 out of 5 years, you get a $250,000 exemption on the gain if you're a single, and $500,000 if you're married. So unless you live in Silicon Valley where houses are selling the millions, it's very difficult to have to pay taxes on the sale of a residence.
So when you were talking about the 250 and 500, that is the gain, meaning over what you paid originally for the house, right? So the improvements that you made in the equity that you were able to raise in your home as a result of your renovations, and if the market has improved, right? Especially in today's market.
Let's go back to your example or my example, $200,000 house, another $40,000 I put into it, and I sell it for $300,000 10 years later. That $60,000 gain is not taxable because it would fall under the $250,000 or $500,000 exemption level.
Got it.
So it's rare for people to, and if you go back 20 or 30 years, there was a one-time lifetime exemption and you had to keep buying houses. This is another question I get from clients. And these days you can actually claim that exemption every 2 years, as long as you lived in the house. So it's very rare that people have to pay taxes on their personal residence.
Got it. Okay. And what we were also talking about, and you mentioned tax credit versus tax deduction. Can you talk a little bit about that as the difference between the two? Because I know people get confused.
People get confused all the time with that. And that's a great question. So the way your federal taxes work is you add up all your income, and then the government allows you to deduct certain things, and there's a couple of ways that they do it, and those things are called deductions. So for example, you're able to deduct the cost of money you put into a retirement account in an IRA or a 401k. You're able to deduct a portion of student loan interest. Those reduce your income. You're able to deduct mortgage interest, real estate taxes. Those are itemized deductions. And when you take those deductions off, you come to a number that is called taxable income. And then you apply tax rates and come up with your tax. From that, you get a credit or credits, which actually reduce your tax dollar for dollar. So for example, there's something called the child tax credit, where if you have children under the age of 16, under the age of 17, 16 or younger, $2,000 per child comes directly off your tax bill. So that's a credit as opposed to a deduction, which reduces taxable income. So this stimulus payment that I mentioned before, that's a tax credit. So if you didn't get the check from IRS, you would get a $600 credit to directly reduce your taxes when you filed them for the bill that was passed in December.
So hypothetically, you owe $3,000 in taxes, but you never got that check for $600. that means you're actually going to owe 2,400.
Correct.
Got
Correct.
it. Okay.
Whereas if you had mortgage interest and you deducted mortgage interest, it would reduce your taxable income. So a deduction is worth less to you than a credit. A credit is worth dollar for dollar. It reduces the amount that you have to pay.
Got it. Okay.
And let me say one other thing, and we work with a lot of business owners, and people ask whether I should spend money at the end of the year, and because I'm going to get a deduction for it. And I remind them that it's a deduction, not a credit. So if they spent $100, they would get a deduction for maybe 20% of what they spent. And that it would turn into a $20 tax benefit. So they're not getting something for free. And I encourage people to only spend money on things that they would spend it for anyway. Think about when's appropriate to spend it. But remember, it's a deduction and not a credit. So just because it's a write-off, quote unquote, that doesn't mean that the IRS is paying for your expense for your business, just a portion of it.
Okay. Now let's talk about being audited. How common is that? Because people sometimes ask me about that. Is this something that's you see all the time? Like, what do you see typically? Is there some kind of a percentage?
I think the short answer is it's a lot less likely than people think.
Okay.
The IRS audits really less than 2% of tax returns. There are certain things that make it more likely to be audited. And very high income levels can push that up because the IRS is interested in getting the taxes that are owed to them. So there's sort of more opportunity for the IRS to do that if they do that. The other one is if you own a business and file as a self proprietor, that can drive it up to maybe 5% of those returns get audited. But even that is 1 out of 20. And so what we see is very, very few people getting audited. And when they do, it's oftentimes a narrow question about one item on a tax return. And so we encourage people to follow the rules, to save their documentation for 3 years after they file their returns, but don't lose sleep over being audited, especially if you've claimed the income that you've earned and been compliant with the laws on taking deductions too.
Okay, so that actually brings me to a couple other questions. Once taxes are filed, then let's say you're just a regular homeowner, you don't have the business. How long should you keep all of your documents and records and the filed taxes for? Is there a good time frame?
Yes, and it doesn't matter whether you own a business or not. The IRS can only go back and change returns and ask questions about returns for 3 years after you filed them. Okay. So for example, if you filed your 2019 return in 2020, you should save everything until probably the end of 2023, and then you're covered. So if you think of it as 3 years after you file or 4 years after the year was over, you'll be fine. There's no need to save things for 10 or 20 years.
Okay.
Whatsoever. And by the way, at the risk of stating something that might be obvious, if fraud is involved, then they can go back forever. But let's just assume that people are being honest and might, have a question about something.
As us homeowners, what is important documentation that we should keep for taxes, for tax purposes? Is there some kind of like rule standards? Okay, here are the 5 documents, for example, that you should have.
Sure. Well, the big things that we talked about the gain if you ever sell your house. So let's talk about that. You should be able to document what you paid for your house. So the closing documentation when you buy your house. If you make big improvements like you talked about, you should save those receipts and like for what you spent for the contractor to put that new kitchen in or bathroom. On an annual basis, you're able to write off mortgage interest and real estate taxes are the big things. Banks will send you a Form 1098 that documents the interest that you paid. And then you've got, if you sometimes pay it through escrow, but sometimes pay it directly, documentation of canceled check, or bank records for those, for the real estate taxes that you paid. Those are really the only things that as a homeowner that I think are important.
Important to keep. Okay. What I also wanted to ask you is with retirement savings, and is there a rule of thumb, or let's say, you, like, for example, I usually contribute to my retirement funds when I do my taxes, and I kind of have a look back of the whole year, and then I'm able to analyze and say, okay, this is what I'm comfortable doing. And, the goal for me is to do it every year. And do you have any thoughts on, because we have two basic accounts without getting into more complicated things, but that's your traditional and then your Roth IRA. Do you have any suggestions on what might be preferred over another, or maybe the answer B would be depends?
I think the answer is it depends. And so here are the differences. The traditional IRA gets you a tax deduction when you put the money in.
Mm-hmm.
Or traditional 401k gets you a tax deduction when you put the money in. So if you contribute $4,000 to an IRA or your 401k at work, it reduces your taxable income by that amount then. And then that money stays in that account all the time you're working until you retire, and it hopefully grows and has earnings. And then when you take it out, you pay tax on both how much you paid in and how much you or the earnings that you're taking out. So all of it gets taxed later. So if you're paying at a higher tax rate when you're working than when you're retired, which is possible for many people, you'll save a bit of taxes from that, but you'll have had all those years of earnings. A Roth IRA or a 401k does not get you a tax deduction when you put the money in, but then when you're retired, both the earnings and the amount you paid in come out tax-free. And so the other thing about a Roth is you're not required to take the money out. If you pay money into a traditional IRA, once you hit now 72, you have to start taking that money down because the IRS wants their tax on it. They've never taxed that money. And so I think first of all, the most important thing to do is save, whether you do it one way or the other.
Absolutely,
it's
I
a
agree.
huge thing that we all should be doing to prepare for retirement. But second, for people who are younger and that money might accumulate longer and can get by without having the tax benefit of it, I encourage people to use a Roth IRA because they'll never have to pay tax on it again. If you're closer to retirement, the benefit of having the earnings not taxed when you take it out is a little bit less. So it might be more valuable for you to get the tax benefit while you're working in it, and if you're at a higher tax bracket.
What is the limit for the Roth IRA per year for the person to, because I know there's a ceiling, right, at how much you can put in the Roth IRA?
There is, but it's based on how much your earnings are.
Oh, the Roth limit?
Yes.
Okay.
And so this is another one of those areas for why does it work this way? And the answer is that's the way Congress set it up.
Right.
There are income limits for deductions on a traditional IRA, for a Roth IRA, and they're lower for a Roth. I think for a married couple, you can't contribute to a Roth if you've made over $120,000. And so, by the way, for people at lower levels of income, and I remember this from my daughter was putting money away right after college, and she actually got a tax credit back for contributing to a retirement account. So at the lower levels, the government's encouraging you to save, and I think it's a great thing for people in their 20s to take advantage of, put some money away, and you may, depending on your income level, you may even get some tax benefit to doing that.
Do you have to be 18 to establish an individual retirement account?
No, but you have to be working.
Okay.
So the limits on contributing only comes from what's called earned income. So if you are self-employed or if you work for somebody else and you get a W-2, you can contribute up to the amount of those salary and wages.
Got it. Okay. And another question that I personally have is I have some money invested in stocks, right? And one of those stocks, it was something that my mom and I went in on together. We did like a 50-50. And ultimately, my goal that I see it as is to let that stock accumulate. I have a dividend reinvestment. It just sits there and I don't even, I check it periodically. But my goal is to have that money eventually to be used to help my parents in their, golden years if they need help with, whatever costs, personal or medical assistance, during their retirement. How does that get taxed once you decide to sell some shares of your stock and the earnings on what you originally contributed when you bought that stock, let's say 20 years ago, versus what has accumulated with the dividend reinvestment 20 years from when you started investing? Does that make sense?
It makes perfect sense.
Okay.
And like a lot of things, it's a little more complicated than you might believe. So let's take a simple example.
Mm-hmm.
You buy stock and it doesn't pay dividends.
Right.
And you buy it at $20 and you sell it at $100.
Mm-hmm.
So that $80 gets taxed as a long-term capital gain. And so that's taxed at a lower rate than your ordinary income or your work income.
Okay, not the same tax bracket, right?
No. And for example, if you're under 70,000, basically $100,000, if you're married, there's the capital gains tax rate is 0.
Okay.
And then it goes to 15%, and then it goes to 20% as your income goes up. And so it depends on your situation, really. But then the other piece of it is, now let's assume you bought it at 20 and you got $30 of dividends over the years.
Mm-hmm.
Well, those $30 of dividends, every year you got them, you pay tax on that.
Yes.
So that
right.
just like the house and putting the
Mm-hmm.
addition on, that increases the tax base, the cost basis. So now your $50 of cost basis, your gain would be another $50, and you'd pay tax on that.
Mm-hmm.
So, and again, you'd pay that at long-term capital gains rates, and so you're that's a tax advantage way to sort of accumulate your wealth.
Okay. I may need to pick your brain in more detail on that, and I'd actually give you like a specific example, because I did some projections on what I think the stock is going to be worth based on a conservative rate of return, that I see the stock is going, and I think, okay, this is going to be worth, I don't know, $200,000 down the road. Like, I would want to know what exactly am I going to be taxed on? Let's say if I am in this tax bracket, what is this going to look like? So that's where I was coming from, because that was a little bit weird for me, because I know that, yes, I pay tax on the dividends every year that I earn, because we get the 1098 form or whatever it's called. So,
yep.
Okay.
Yeah, it's an interesting question. And then if you're going to keep holding it, there's always the question of, does the tax law change too? I mean, the tax law, capital gains rates have changed over the years based on different administrations. And it's sort of one of the challenges in saving for retirement. You asked about a Roth or a traditional IRA. That's under current law. It is possible that the tax treatment of those things could change going forward too. And so you never know that. But that's why we do our best in planning based on what we understand the law to be today.
I work with many seniors, and I know that they have family members that help them, right? And they may pay for different things and services to help their parents. Can any of those things be deducted in some way because the family, right, the kids are helping their parents?
Boy, it's difficult to do that unless it rises to the point of somebody being a dependent, and the test for being a dependent is to provide more than half of their income.
And it can be a parent, right? It doesn't have
to be a parent. Yeah, sort of the classic dependent is your children.
Okay.
And then there's a category of other dependents, and those other included in that category are are parents. And so if you're providing over half of their income,
Mm-hmm.
perhaps late in life, they've moved in with you, they no longer are paying rent, they no longer are buying their own food, then they would qualify as a dependent. And you'd be able to deduct, first of all, you get a tax credit for them as another dependent.
Mm-hmm.
And it depends on some of the other factors too. But the real test is where the money, who's paying the money.
Right.
If it's you paying the money, then there's a chance if they're a dependent for you that you could deduct, for example, medical expenses or something like that. But if you're painting their house, getting it ready for the sale, that's not really going to be a tax benefit for you.
What if I needed to buy my parents a house to live in, where, when you do, because this is something that I am starting to think about, right? My parents are getting into that age bracket where I was like, I would like to start making some plans in case they need my help down the road. Is that, what if it would make more sense for me to buy them a small home that is 1 story to live in versus having them live in a continuum care community, right? And I'm buying this for my family, like for my parents. Is that still going to be considered to be an investment property based on the IRS guideline?
And are they paying you anything for it in terms of rent?
I didn't think that far.
Yeah, I think it. I
Okay.
mean, maybe you have them pay you a modest amount of rent, and then you treat it as an investment property. I'm assuming they're not at this point a dependent.
No, like if they were, maybe if I say, okay, I'm going to buy this house, can you just cover the mortgage and the expenses, right? Because
and so you're in essence collecting some rent,
okay,
and maybe you're paying some of the other. Just like you would with any tenant.
okay,
There's a relationship that you've got where they pay utilities or you pay utilities. And I would suggest if you go down that road, you formalize it
sure,
and do it in writing,
mm-hmm.
So that it's understood, because related parties can always be subject, to question that was this a real deal? Was this an arm's length transaction? But there's no reason you couldn't rent a property to your parents.
So then that would go on the taxes is going to count as investment property, where we would have the income and then the expenses that can be deducted
Correct.
for that property. Got it.
Correct. And depreciation.
Sure. Sure.
Yeah.
Okay. Well, is there anything else that you want to share that maybe I haven't asked that either me or other people need to know as we prep to file 2020 away?
What else is there? Well, one thing you asked about business expenses and deductibility and those things for people that own their own companies. One of the other changes in the law, to go back to your first question, was designed because restaurants have had such a hard time in this pandemic. Forever, basically, business meals have been deductible only 50%.
Right.
So if you spend $50 on a lunch with a client, you get to deduct $25. For 2021 and 2022, you get to deduct 100% of
Okay,
that.
so that was already decided for 2 years, right?
Only for 2 years. And the whole idea is to get the restaurant industry, the local restaurant industry, back on its feet and make it easier for people to go out and do that. Will they do it? I don't know. I hope so.
Well, I try to have coffee on a regular basis with, my clients, and I try to, invite some of the professionals like you. Well, that's been kind of on hold for a little while because we can't see each other, and a lot of places don't have, the ability now to host inside. So I hope that changes.
I hope it opens up. Yeah, I hope people are able to survive
Awesome.
This next round. Yeah.
All right. Well, thank you so much for spending the time with me. I appreciate it. I think we're going to have another session at some point and talk actually about real estate investments, which I'm really excited about.
Sure.
So, and I'm going to include your contact information under this video when I have it posted. So that way, if anybody has any questions or they need help with their taxes, they can reach out to you directly.
That'd be great.
All right. Thank you so much, Paul. I appreciate you very much.
Great to be here today. Thanks.